TD and RBC just made steep downgrades to their Canadian housing forecasts, and the data behind their decision reveals just how broken our real estate market has become. Welcome to the Daily Brief Canadian Macro. I'm Steve. Today we're covering three major developments affecting Canadian investors. First, insights on Fed policy timing and what a potential leadership change could mean for monetary policy from the David Lin Report's interview with Axel Merck. Then Market Mania breaks down why major Canadian banks are dramatically downgrading their housing forecasts as multiple markets show 30% declines from 2022 peaks. Loonie Hour reveals new data on how dependent first-time homebuyers have become on parental assistance, and we've done our own research this week on a story the housing conversation keeps putting off the front page: the federal public service cuts, who's getting hit, and what it means for Canadian investors. Let's start with the Fed. Today, the David Lin Report featured Axel Merck, CIO of Merck Investments, discussing U.S. Fed policy timing and a potential leadership transition. Merck's thesis is that we're heading toward a significant shift in how the Fed operates, with Kevin Warsh positioned to replace Powell and return to pre-crisis monetary operations using Taylor rule-based policy. He points to Powell already adopting Warsh's talking points on productivity and acknowledging failed communication reforms. On rate cut probabilities, and this is the U.S. Fed, not the Bank of Canada, Merck sees a 50% chance of cuts in December, 75% by March, and 90% by June next year. He also argues that Fed micromanagement prevents natural recessions, pointing to how they created another program to shield banks from consequences when they mismanaged interest rates 2 years ago. Here's why that matters directly for Canadian investors. The BOC has already cut 9 times between June 2024 and October 2025, leaving the policy rate at 2.25%, while the Fed sits at 3.75%. That gap has been working in the loonies' favor. U.S. CAD is trading around $1.38 today, down from generational lows near $1.48 in February per U.S. dollar. But if the Fed enters an extended cutting cycle, that differential narrows and potentially flips. A stronger Canadian dollar is not automatically good news. Our exports are priced in U.S. dollars. Oil, lumber, manufacturing, and a rising loonie erodes competitiveness across all of them at a moment when the sector is already under tariff pressure. The BOC is boxed in too, with inflation still above target and Scotiabank forecasting a rate hike in the second half of 2026. There's almost no room to cut in response to CAD appreciation, even if they wanted to. Next decision is April 29th. Watch the language around exchange rate sensitivity closely. Over on Market Mania, they covered how TD and RBC have dramatically downgraded their housing forecasts as Canada's real estate market shows clear signs of breaking. Multiple Canadian markets are already down 30% from February 2022 peaks: Barrie, Simcoe, Waterloo Region, Niagara, Peterborough, Hamilton, and Peel, with Toronto down 17% and Vancouver down 12 to 13%. TD's downgrade is confirmed. As of December, they were forecasting a 9.3% year-over-year gain in home sales and a 4.1% price increase. They've now flipped to expecting sales to fall 1.8% and prices to edge down 0.3% nationally, with Ontario and BC taking the steepest hits. The channel also points to Statistics Canada showing approximately 75% of people in negative savings territory since 2021. Our research puts a finer point on that. StatsCan household accounts show the bottom 2 income quintiles running persistent savings deficits. Not 3/4 of the population. But when you're talking about the bottom 40% of earners deepening their savings hole year over year since 2021, that's damning enough without the rounding up. Market Mania also puts variable mortgage rate adoption at 45% of new loans. Our research puts that closer to 17% based on RateHub's mortgage request data through November 2025 and the 2025 CMHC Mortgage Consumer Survey, which puts fixed-rate contracts at 62% of all new mortgages. Both sources do flag variable inquiries rising sharply into 2026 as the spread between fixed and variable has widened. The direction is the point. Canadians are being priced out of fixed rates. That's the real signal. The Loonie Hour focused on first-time homebuying dependence on parental assistance. Their main point is that home buying has fundamentally shifted from an independent milestone to a family-dependent process. The Bank of Canada data published earlier this month confirms parental co-signing has tripled nationally from 4% in 2004 to nearly 11% today. In Vancouver and Toronto, it's nearly 14%. Real estate professionals in Vancouver observed significant down payment gifting on top of that. The Loonie Hour puts total parental assistance at 90% of first-time buyers. Hard to square with the primary data. The Bank of Canada puts co-signing at 11% nationally, and CIBC finds roughly 30% of first-time buyers received a direct cash gift from parents. Stack those together, accounting for overlap, and you're looking at something closer to 40 to 45%. Still a staggering structural shift, and the Bank of Canada itself called it an emerging vulnerability for the financial system. That framing doesn't need any inflation. While everyone in Canadian finance content is focused on housing, there's a workforce story unfolding that nobody is mapping in full, significant enough that Canadian investors should be paying attention. The Carney government's Budget 2025 committed to shrinking the federal public service from 368,000 employees at its peak in 2024 to 330,000 by 2028-29. Roughly 40,000 positions over 5 years, targeting $13 billion in annual savings, are to be cut. Since December, more than 23,000 federal workers across 24 departments have received workforce adjustment notices. Not all result in layoffs, but the scale is not a drill. The 5 departments hit hardest are Global Affairs Canada, Statistics Canada, Employment and Social Development, Health Canada, and Transport Canada. Statistics Canada alone is cutting 850 to 900 positions out of a total staff of roughly 7,200, more than 12% of the agency that produces Canada's GDP, employment, inflation, and census data. The Professional Institute of the Public Service was direct. The people being cut are scientists, inspectors, engineers, analysts, and technical specialists. The infrastructure behind the data every Canadian finance channel relies on every week. The geographic concentration matters even. The public sector accounts for nearly a quarter of all employment in Ottawa. Statistics Canada shows Ottawa experienced the largest employment loss of any Ontario city between February 2025 and 2026. 30,500 jobs gone. Unemployment up to 6.3%. One number to watch, Statistics Canada is simultaneously cutting 12% of its staff and running the national census this spring. The census feeds every demographic and housing data set Canadian investors and policymakers depend on for the next 5 years. That's a data quality risk hiding in plain sight. While multiple pressures are converging on Canadian households and investors simultaneously, major banks are finally acknowledging housing deterioration. A growing share of first-time buyers can't enter the market without family help, and the federal public service contract is already showing up in regional employment data, while the institutions that are producing Canada's economic numbers are being hollowed out at exactly the moment investors need reliable data most. The question isn't whether the stress is real. It clearly is. The question is which pressures are already priced in and which ones the market are still ignoring. A multi-year fiscal contraction in government employment concentrated in the capital hitting data infrastructure on top of trade uncertainty and a soft labor market is not a small variable. Well, that's your Daily Brief for today. All credit goes to the creators featured. Their original analysis and videos are linked in the description below. If you found this video helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.